Polymarket seeks U.S. regulatory approval for margin trading. Polymarket has approached U.S. regulators for permission to offer margin trading on its prediction markets, according to a Bloomberg report shared by Cointelegraph on July 10, 2026. The move would let traders open positions larger than their deposited collateral by borrowing against it, a mechanic common on crypto derivatives venues, but new to event contract platforms operating under U.S. oversight. The request lands as Polymarket rebuilds its footprint in the United States. The platform spent years geo-blocking American users after a 2022 settlement with the Commodity Futures Trading Commission, and its path back onshore has run through federal derivatives rules rather than crypto exemptions. Adding leverage to that mix raises the regulatory stakes considerably. The specific ask margin trading lets a user control a position worth more than the cash they put up. On a prediction market, that means a trader could wager, say, $1,000 on an outcome while posting only $250 in collateral, with the remaining $750 effectively borrowed against the position. Gains and losses both scale to the full $1,000 exposure. For a venue built on binary yes or no event contracts, that changes the risk profile sharply. A contract that settles at either $0 or $1 already carries total loss potential on the wrong side. Layering borrowed money on top means a trader can be liquidated before an event even resolves if the market price moves against them, and their collateral no longer covers the position. Bloomberg's report, cited in the original Cointelegraph post, frames the approval request as a formal regulatory filing rather than an informal sounding out, though the exact agency and product structure were not detailed in the initial coverage. Leverage draws the highest scrutiny. U.S. derivatives regulators treat leverage as one of the highest scrutiny features a retail-facing platform can add. Margin introduces counterparty exposure, liquidation cascades, and the possibility that a trader loses more than they deposited if positions gap through their collateral. Those are the exact mechanics that drew enforcement attention to offshore crypto exchanges offering high-leverage perpetuals to U.S. residents. Polymarket approaching regulators openly, rather than routing leverage through an offshore entity, signals it wants this inside the license perimeter. That is the harder path, but it is also the one that survives. A green light would make Polymarket one of the first U.S.-accessible event contract platforms with sanctioned margin, setting a template competitors like Kalshi would have to answer. The timing also matters against the broader policy backdrop. The SEC has been readying a crypto safe harbor proposal, and prediction markets have been testing the boundary between regulated event contracts and gambling for 2 years. A margin approval would be a concrete signal of how far U.S. agencies are willing to extend derivatives-style features to this category. The trader-side math leverage cuts both ways, and on all-or-nothing contracts, it cuts fast. Consider a trader who believes an outcome priced at 40 cents is underpriced. Unleveraged, a $400 stake buys 1,000 shares that pay $1,000 if the event resolves. Yes, a $600 profit. With 4x margin, the same $400 collateral could control 4,000 shares, turning that into a $2,400 profit. The reverse is just as steep. A no resolution wipes the full leveraged position, and an adverse price swing before resolution can trigger liquidation partway through. That asymmetry is why leverage tends to concentrate returns among a small set of well-capitalized traders, while accelerating losses for everyone else. Prediction markets already skew toward informed money. Margin would widen that gap. The connection to how people fund these bets crypto prediction markets settle in stablecoins, and how a trader funds a leveraged position becomes a live cost question when borrowing enters the picture. Traders moving USDC on and off Polymarket already weigh the friction of getting fiat into stablecoins, and margin adds interest or funding costs on top of that base. For anyone routing spending and settlement through stablecoin rails, the effective cost of a leverage bet is the funding rate plus whatever spread they pay to convert in and out. This is where the mechanics overlap with everyday crypto money movement. Stablecoin volume hit a record $1.79 trillion in June, and prediction market collateral is a growing slice of that flow. Leverage would amplify the turnover without changing the underlying settlement asset.